William Foster Moody is joining us live from Washington, D.C., along with our other guests. William, appreciate you joining us here on the program. Let me ask you, William, what has specifically made you change your mind about the India story? I mean, there was absolutely, a very palpable disappointment last year. The government believed that this ratings upgrade ought to have happened last year. In fact, officials went on record to question the methodology adopted by Moody. One like the chief economic advisor, Arvind Subramaniam, even calling it egregious and compromised analysis. So what has changed specifically over last year for this upgrade?
Well, it's important to keep in mind that we put India's rating on a positive outlook in April of 2015 with the anticipation that the reforms that the government was moving forward would ultimately result in results that were clearly improving the credit profile moving forward. We reviewed that last year in November of 2016, and the committee decided that we just didn't have sufficient evidence at the time that the reforms were indeed actually resulting in the type of transformation that we need to see in the real economy, in the financial system, that would support a stronger credit that's at the Baa2 level. And so we decided to maintain that positive outlook rather than make any firm decision about the actual rating itself. And what we asked for is really time to get a better grasp over the next year as to whether those reforms will indeed change the story. And this week we decided that we do have sufficient evidence, we have greater confidence that indeed the reforms are changing the outlook and strengthening the credit profile to the extent that it now is a Baa2. And we think that despite the short-term disruptions that we've seen over the last few quarters following demonetization and GST, they and many of the other reforms together, and there's no one reform in isolation that we're looking at or that was the driver of this decision. It's the culmination of all of them creating a framework or a foundation for higher sustainable growth in the future and eventually an improved outlook for revenues and ultimately a more efficient expenditure that will help strengthen the credit profile in the future along with institutional reforms.
Okay, so William, you said that in November you didn't have enough evidence to prove that the reforms that the government had undertaken would result in the kind of action that would merit an upgrade. You have the evidence today is what you're telling us. Can you shed more color and light on what gives you the confidence that the India story has the potential to grow and our credit profile, in fact, is a lot better today?
Well, I think it's important to remember in November of last year, this was, basically when demonetization was announced, very much surprised, I think, everybody. So there was a lot of uncertainty around demonetization and what that would do to the economy and what the overall impact would be. There was a lot of uncertainty around GST as to whether it would make the April deadline, and it was pushed to July. But it was unclear whether it would actually be implemented. There was uncertainty around the FRBM committee recommendations and to what extent those would be, what the recommendations would be, and ultimately what the government would think of them, along with the banking system and the twin balance sheet issue. And all of these issues, they haven't been fully addressed necessarily, but we have greater clarity, at least at this stage, as to what we expect the impact to be over time. And we do expect it to be favorable. In the near term, consistent with our view on India's kind of the implementation on reforms in India, it's slower than you might anticipate, it's slower than you might want, and sometimes it's incremental and there need to be changes, as we're seeing, for example, with GST, where there's been some forbearance on compliance for SMEs and exporters, et cetera. But ultimately, we think that the reforms will mature and fundamentally in the medium term will strengthen growth and the credit profile moving forward.
Okay, so let me, before I bring our other panelists in, William, ask you, what could move the rating higher from here on, and what are the downside risks? External volatility, and I would imagine things like crude oil prices, etc., would impact a possible revision on the downside. But what are the upside as well as the downward risks that we should factor in?
Sure. So the binding constraint on the credit profile is still a very high debt burden. India's debt-to-GDP ratio is about 68% of GDP relative to the median for the BAA space, which is 44%, so it's significantly higher. If we were to see a significant decrease in that debt to GDP ratio in a shorter amount of time than we would expect. Because at this stage, we expect it to be relatively stable and slow, but gradual, but not to go up. And that's the important thing. That would be potentially grounds for considering another upgrade. So fiscal consolidation at a fast pace, in addition to other reforms that would really push growth forward and potentially investment in particular, stimulate investment. So things like labor and land reforms that were exceeding expectations. On the downside, you mentioned oil prices, and that obviously feeds into the current account deficit, external vulnerabilities. India has come a long way since 2013, when the current account deficit was 5% of GDP. It's under 2% today. It may get as high as up to 2% this year, but we expect it to stay more or less within the range of 2% and lower moving forward. Because ultimately the global outlook is such that we don't anticipate oil prices shooting up very, very sharply as they have been in the past. At the same time, India has built up, an all-time high for foreign exchange reserves that gives them a buffer to be able to weather potential volatility moving forward. But the banking system is an issue. Obviously, we think that the announcement for the recapitalization is positive for the sovereign, but it'll basically, our view is that it allows the public sector banks to now take down the write-downs that they need to do and move forward with the resolution process. It's not sufficient in and of itself. It's an incremental step forward to repairing the balance sheets, which is necessary for the banks and ultimately for the corporates as well. So if that doesn't play out well, and there's contingent liability risk that keeps rising, the banking system doesn't get repaired, then that, along with the most likely impact on the investment cycle not turning, things could potentially deteriorate. If the fiscal deteriorates further, that would be potential downside risk to the rating.
Well, since you're talking about the fiscal risks and fiscal consolidation, let me bring in the Economic Affairs Secretary, Mr. Subash Garg. He joins us on the program. Mr. Garg, Moody's upgrade, as we've just heard, is largely dependent on the fiscal story, the NPA resolution process, and of course, including the PSB recap and the GST move. Let me start by asking you, sir, first about the fiscal deficit. There are indications that you would like to stay on course on the fiscal consolidation roadmap that's been drawn out. But the worry and the challenge is that will you be able to stay the course? What is the plan of action? Also, I know that the government has said that a final call on 3.2 will be taken in December, but what about the macro environment? We've seen pressure on crude prices. There is uncertainty on the GST revenue front. So give me a sense about the fiscal consolidation roadmap and the fiscal deficit target.
You seem to be going much beyond what the Moody's report is based on. And Moody's assessment, I think they have affirmed in a very emphatic way India's growth potential, which is now secured based on the structural reforms which have been undertaken, institutional reforms which have been taken up in the last couple of years, and a very credible fiscal management story. So I think that is what underpins the Moody's assessment. You have yourself in your question acknowledged that this is the year which is the transition year, which is bearing the impact of all these big reforms and all. And therefore, there is, for this particular year, the government's long-term, government's medium-term commitment to fiscal reforms and fiscal consolidation is very clear. We started at 4.5%, we've gone down, brought it down to 3.2%. Government's commitment to go to 3% is also very well articulated and clearly stated. And this year's, because of these uncertainties about the impact of a lot of measures, we've been saying consistently that we would be in a position to make a reasonably credible assessment only by the end of December.
All right, let me go across now to Rathin Roy, member of the Prime Minister's Economic Advisory Council. Mr. Roy, do you believe that this upgrade will now bind the government to its fiscal promises from here on?
No, this rating has come as a consequence of the government sticking to its promises. The government in its budget says we will maintain a fiscal deficit of X this year. For the last 5 years, at least 4 years, the government has maintained that promise, more or less, right? So what this rating is reflecting is the credibility of government, and that has nothing to do with the rating. Government must be credible. When it says it will do something, it must do so. And unfortunately, in India, we have not had a record of government credibility that's been very attractive in the past. I think we have made a lots of progress over that in the last 15 years, including the last 4 years. So yes, I would hope that with or without this rating, the government of India and the state governments would stick to the fiscal deficit targets that they have announced, what is it now, at least 8 or 9 months ago in the budget.
Right, so let me now bring in Mr. N.K. Singh, Chairman of the FRBM Committee. Sir, Moody's in its report says on the fiscal front, efforts to improve transparency and accountability, including through the adoption of a new Fiscal Responsibility and Budget Management Act, are expected to enhance India's fiscal policy framework and strengthen its policy credibility. Your report is with the government, sir. Whether or not we have a winter session, we don't know, and the possibility of it being taken up in the budget session looks more likely. A, your reaction to the upgrade that's come in from Moody's, and B, your outlook on the adoption of the recommendations that your committee has presented and what that could mean as far as India's fiscal future is concerned.
Well, I think that first, I think, Shireen, we must notice an important point made by the Moody's, both in the report and then in the explanation which has been given, is that this is the outcome of a constellation of measures. This is not as a result of only one act or one measure. These measures include, no doubt, an adherence to the congruence of a stable monetary and fiscal policy, the continuation of the fiscal consolidation strategy. And I agree with Rathin that few governments in the past have demonstrated their adherence and commitment to promises which they have made, as this government has. And it is in some way, therefore, quite ironic, as the finance minister pointed out, that 13 years ago it was the Baa3 government which led to the upgrade, and 13 years down the line, it is another NDA government which has inspired this degree of confidence on the fiscal roadmap leading to this upgrade. But this has to be read in congruence with many other factors. The issue, there is no more candid endorsement of the government's reform strategy on GST and demonetization in terms of the formalization of the economy. And if you read this report in conjunction with the report of Morgan Stanley, which they took out on the 23rd of October, in terms of what the digital economy can do to India in terms of India's growth story, and the fact that this is therefore a whole host of commitments on structural reform. Now, your second question, it's not one single measure, therefore it's a constellation of several measures and a commitment of pursuing this important reform story, which will enhance productivity of the system, growth, create virtuous cycles between investment, rekindle private investment, and make a deep dent on the twin balance sheet malaise which has afflicted private investment. Now, your second question, how sanguine I am on whether the fiscal roadmap, which the government has said will be adhered to by government. I am quite sanguine that I have every reason to believe that the finance minister's commitment which he made of 3.2% this year, and as Subash Garg has rightly pointed out, their commitment to go to 3% next year and then beyond that, which will therefore make a big difference on the one overarching factor which the Moody's has pointed out, namely the debt trajectory moving in a downward direction and the preferred debt to GDP ratio being reached in some foreseeable future, notwithstanding the temporary dislocation of a 1% deterioration on the debt GDP this year, which they have pointed out in the report. But I think that as growth picks up, nominal GDP picks up, you create virtuous cycles, which is therefore more than going to compensate in the medium term. And therefore, India's development and growth potential being significantly higher than countries which have had this kind of a rating has been one important factor in prompting Moody to make this upgrade.
Before I move back to Subash Garg, Mr. Singh, any indication on whether the report is going to be taken up in the next session of Parliament, sir, whether it's winter or the budget session?
Well, I mean, frankly, they have to come to a conclusion by the time of the budget session, because what the fiscal numbers are will have to be certainly be made transparent when the budget is presented. This doesn't, of course, Shireen, mean that many other features of the FRBM report are necessarily would be adopted by the government. There are issues of, for instance, escape clauses, conditions of escape clauses, the limits of escape clauses, modalities of invocation, fiscal council, etc. There are many features in this report which go beyond mere fiscal numbers.
Yes, there are. William, let me come back to you before I go back to the DA Secretary on the point that Mr. Singh made, that in the FRBM, the new FRBM Act, which hasn't been adopted yet, but were it to be adopted, there is the possibility of giving the government some leeway by way of an escape clause. Do you believe that that at all is likely to be triggered, given what you've seen today, and also the push on an aggressive disinvestment roadmap? Do you believe that the 3.2% fiscal deficit number at this point looks like it's going to be met?
So what's most important to us is the medium-term commitment, really. You know, within the short term, there can be some flexibility around deficits, but what's most important is that over time, the government is committed to bringing down the deficits and to bringing down the debt to GDP ratio. So really that's what we're focused on, and that's what the FRBM committee recommendations focus on.
If 3.2 were to become 3.5, sorry,
sorry,
I'm interrupting you. Yeah, sorry, I'm interrupting you. So if 3.2 were to become 3.5, for instance, next year, that's fine. Okay, okay, great.
Well, actually, Sharon, just to clarify, we actually have 3.5% as our current forecast. We're expecting, you know, some of the recent measures and issues around GST implementation, for example, and you know, some of the extra costs to result in a slight deviation from that. But ultimately, that will be made up for in the next year or so, and ultimately, it could be made up for with disinvestment and other factors, or cutbacks in spending. But the most important thing is that commitment to the medium term and not straying too far from those deficits.
All right, got the point that you're making. Let me go back across to the Economic Affairs Secretary. Sir, you know, as Mr. Singh was pointing out, a constellation of reforms responsible for the upgrade, not just a single reform. So give me a sense now on what next we can expect as far as the reform agenda is concerned, staying the course on what has already been done and what more we can expect.
The one very clear way to remain on course is to continue to implement the big steps which have been taken. They're not all finished. We are not all done with it. We are in the process of whether it is GST, bankruptcy, digitalization, Aadhaar, and everything. So complete that story, stay focused on bank capitalization, stay focused on infrastructure story to build the base for growth. So you stay on, and it's not going to be easy. It has to be. It has been tough. It has required bold decisions, and that kind of commitment will have to continue to see that we don't slip and we stay course.
Well, that kind of commitment will have to continue. So, Rathin Roy, let me ask you then, does this give the government a little more time to do the less difficult things? And what, to your mind, requires urgent attention from here on?
Now, if you're asking me whether there's more to be done, of course there is. Like I said earlier, this is a test match. We have a long road ahead of reforms. We are nowhere near 8% growth yet. We know that there are important structural impediments that we have to overcome. And with or without ratings, we will do those. We have to do as India what we have to do to get to 8% inclusive growth. And in the process of doing so, we need one thing. We need larger and cheaper flows of finance on commercial terms to fund our development transformation in the long run. That rating upgrade gives us access to that larger and cheaper flow of finance in the long term. And the more upgrades we get, the more funds we will get, and the faster and more secure will be our development transformation, but that's only one element. The other element is doing things that we believe we ought to do because they're important for our economy to grow. And if that, in addition, helps us attract rating upgrades, so be it. So that's my nuanced answer to your question.
Well, there's a lot more to do to be able to get back to the 8% trajectory. NK Singh, let me give you the final word on the show, sir. What next? What more? What would the priority list look like for you?
Well, I think that the priority list must encompass the a federal compact. And I think that a lot of the action, not only, Shireen, on the fiscal story, but if actually the rating agencies will look to the country rating as a whole, it is really the deficit of the general government. And I think we need to pay attention to what is happening in the states. And that is why not only in regard to the fiscal story of the dynamics as it plays out in the states, but on some of the other matters which were mentioned by Moody, like factors of production, of land and labor, and so on, we have to really nudge the states, incentivize the states, so that they become a part of the Team India story.
Well, that is a good note to end this program on. Gentlemen, appreciate you joining us here. William Foster, Rathin Roy, Subash Garg and Mr. Singh, always a pleasure speaking with you. But here are two more influential voices on the upgrade. Mincing no words, the big bull calls this an emphatic reply to the government's critics and also added that this does not surprise him a bit. Echoing those sentiments, the veteran of India's financial services industry, Deepak Parekh, saying that this was long overdue and rating agencies have not been fair to India.
I think first it will allow India as a government to borrow at lower rates. There will be a lot of participation of a lot of funds who by their mandate can only invest in countries which have a certain rating.
Okay.
So a lot of pension funds will be allowed to invest in Indian debt and also in Indian equity.
We deserved it much earlier. And rating agencies always take their sweet time, and they take 3 months, 6 months to keep analyzing and see what happens. If they are ready to upgrade and some negative thing happens, they'll again delay it by 3 months. So I think it was long overdue. And I always feel that the rating agencies have not been fair on India, because particularly the last year, year and a half, the number of reforms, and these are transformational reforms.
Absolutely.
These are big bang reforms. These are not incremental reforms. And these have been executed by the government. And on these grounds, they should have done it much earlier.